Hope everyone is having a good day, a good trading week so far. I know it's been kind of crazy out there. We're going to talk about what I'm seeing in the markets and kind of how I approach an environment like this, because this kind of volatility is a little bit bonkers. And so it does change how I trade, how I approach markets, how I size positions. And I think that's a really important concept to discuss a little bit more as we enter a different trading regime. I don't think that the old trading regime that we were in is in effect any longer. What I mean by that is sort of just grinding higher on low volatility. I think we're in a much higher volatility environment with lower liquidity. So before we get further into that, we're going to go through a couple of different slides here real quick. And then we'll start talking a little bit more about what I'm seeing. First, let's go over the disclosure here. And you know what? I've got a different deck I usually use for this, but we're just going to go with this one for now. So if you'd like to join the Bookmap Discord, please do. You can hit this link here. You can go to discord.com/invite/bookmap. You may have a better experience there. It's certainly going to be lower latency on the Discord. And remember that all Bookmap Ltd materials, presentations are for educational purposes only, should not be considered specific investment advice or recommendations. A little bit about me. My real trading journey began in 2005, funding my own account and trading stocks, then moving on to options, futures, and Forex. I navigated through the great financial crisis, which helped me to better appreciate the importance of understanding intermarket dynamics, momentum, and macro. And my approach is systematic, driven by momentum, price action, options flows, volume profile, and the big picture. I began working with Bookmap in early 2022 because I saw great value in the way their platform displays market data. And you're welcome to follow my work on Twitter and YouTube. You can hit Mayhem 4 Markets, that's Mayhem number 4 Markets. My trading ideas, coaching, and unique market tools are available at TraderAid.com. My long-term trading and investment ideas, research, and institutional consulting services are available at macrovisor.com. And if you'd like to get up to 40% off of Bookmap, visit TraderAid.com/bookmap. That's TraderAid.com/bookmap. And I live stream every Tuesday for Bookmap, concentrating on how I use Bookmap to analyze order flow at 9 a.m. Eastern. So with that, let's go ahead and dive into Bookmap here. First thing I want to draw your attention to is order book depth. You can see here we're at about 39,000. It's still pretty low liquidity out there. And this is sort of the impetus of what I wanted to talk a little bit about today, which is this idea that this is a lower liquidity trading environment. Lower liquidity tends to lead to higher volatility. And so what that means for us as traders is we need to change how we size our positions and how we manage risk, right? Because in a higher volatility environment, you're quite likely to get blown out of your positions if you're using the same stops that you're using in a lower volatility environment. The other side of it is, of course, in a higher volatility environment, you need to decrease your position size. So you think about it from the perspective of, how do I maintain my trading in this regime change that we're going through right now? How do I keep participating in the market? Well, first, I think we size down. Second, I think we use wider stops. And third, I think we have to be more, I would say, selective about what trades that we're willing to take on, right? So that's the key takeaway. That's the focus that we're going to talk a little bit more about today as we approach the markets. As you all know, I'm a fan of the 20-minute opening range. That's what I look at to get a sense as to what directionality we may have going into the day. Looking at that first 20 minutes to establish an opening range of high and low price, and then seeing if we break above or break down below, and then what we build to from there. Let's say, we break above, maybe we build acceptance, maybe we start trending higher. That can be a positive trend day, for example. So those are the things that we kind of look at, the clues about momentum. We also like to look at options. I've built this options visualizer tool, and that allows me to visualize what flows are happening from S&P 500 options that may impact hedging in the futures. So it can be a nice tool to have, just to kind of get a better sense as to how options are impacting the market. So for me, going into today, I'm seeing a market that's quite oversold on a number of different metrics. So I do expect we get a turnaround Tuesday pop. Tuesdays are the highest likelihood from a statistical perspective to be an up day. Friday is the second most likely. So that's another thing that kind of works in the favor of an up day here. We also have futures bid, right? S&P futures up 0.5%, NASDAQ futures up about 0.4%. Vol is down, the VIX is down about 12% overnight. All of that also suggests a positive trading day. So I'm going into today looking to validate that theory on the basis of what the price action tells us, what the prevailing intraday momentum tells us. So for me, I'll be really focusing on that as well as the options flows, and we'll talk a little bit more about that and how I qualify that. But the biggest takeaway here is that we are entering a higher volatility regime. So it's not a time to be a hero. It's not a time to go really, really long with leverage. It's a time to be cautious and conservative, because with lower liquidity in the market, it takes less volume to move price. So you can have an event come out of left field and it can absolutely knock the market up or down in ways that we may not expect or be prepared for. And that's why it becomes much more important for us to be cognizant of those risks as we're trying to kind of navigate the trading environment that we're in. So basically what we've seen for much of 2024 and much of 2023, that sort of low volatility grind up, trading days where the opening range is 8 to 10 points, where there's, not a whole lot of intraday realized vol. That environment is likely behind us for a while. Typically from August through October, we have higher periods of volatility, more path of least resistance being lower for risk assets and higher for volatility overall. So I just want to kind of emphasize that, because I know a lot of folks go into trading with the expectation that you can just sort of go max long, go full portfolio into something and, sort of ride it and make a lot of money very quickly. But the reality is that trading is a business. It requires a lot of discipline. So it means that you can't necessarily put all your liquidity at risk in a single trade, because you need to be there the next day, week, month, and year to be able to trade the market. It also means there's some days where you may not find there's anything that you want to trade or that doesn't comport with your system. And there's nothing wrong with that. In fact, it's better to not trade than to overtrade, right? So taking breaks if you don't see opportunities that fit what your profile is, what your risk appetite is, what your goals are, that's fine. So let's dive into Bookmap here. As we are pre-market, we're going to take a look at some of the other markets overnight here. We've got the S&P 500. It had a pretty nice open. We could see when the Globex opened, we had a gap up. We had decent earnings from Palantir. In fact, they were pretty blowout earnings. I think that helped with some of the sentiment in tech. So we saw the NASDAQ, S&P get bid up. As Globex opened at 6 p.m., there was a pretty big gap up, and it continued. And at one point, the S&P was up about 1.3, 1.4% overnight. But you can see when the European session opened, we sort of started to move a bit lower. And then we had a little bit more of a rally back up to that point of control. And now we're starting to grind a little lower again here. It's not terribly surprising if we think about some folks in Europe are probably still having to de-risk. There is overall a dominant deleveraging theme here. But nevertheless, I do think we get a sort of pop today, and it may be a pop to re-offer into for swing trades, quite frankly. I don't necessarily think we're anywhere near out of the woods. My thought on the longer term is that we're in a corrective impulse that could go on for the next 2 months. Doesn't mean it's a path straight down, but it means, in my mind, the path of least resistance is indeed lower. Let's look at the NASDAQ here as well. Very similar picture. You had the NASDAQ well bid into the European Open, faded that down to about 5:30 a.m. We got that pop, and now we're fading lower again. We also have the Russell 2000. This has the exact same look. So all these equity markets are kind of in sync here, right? Fading from that European Open, from those overnight highs. So that gives us a little bit of a sense going into today that we might clean up some of those poor highs from overnight. There certainly could be an opportunity for the market to be rebid. Some of those passive flows that tend to bid the market are actually pretty pronounced right now. You talk about Vanna and Charm, or the decay of SPX options. Those flows are starting to come back. The S&P 500 buybacks, I think about 85% of them are now out of their blackout period. So those flows are also back. And we do still have some remnants of those beginning of month flows as well. So I would say that for the first hour or two of trading, I wouldn't be too surprised if we had some positive price action, but I'm going to let the market be my compass. That's why I like looking at the 20-minute opening range to get a sense as to what kind of trend is forming. And then I'm a sort of slow day trader. That means I'm not going and micro scalping every tick. If I see a trend day and it's confirmed, I'm capitalizing on that trend day by building a position that favors that trend and riding it until it doesn't work anymore, or until I hit my target. And I'm usually taking off my core first, and then I have runners for my more aggressive targets, right? So I'm trading maybe a little different than some folks, but that's worked really well for me. It's prevented over trading. It's improved my hit rate. It's reduced slippage. So I might only take, like on a trend day, maybe total 4 trades, 5 trades, like, you know, building the position and then scaling out. But I've also found that for me, it's much lower stress. I can even bracket trade that once I confirm a trend day. I could throw a bracket order in and just kind of walk away. I don't necessarily even need to monitor every tick. And I think that's good for traders not to burn out micro focusing on every tick. You got to find your opportunity, get in it if it works, and then start focusing on finding the next opportunity while that trade is working for you. Let's take a look at the 10-year note futures, because everyone's been talking about bonds. They've had an incredible rally, biggest drop in yield since 2008 last week. And we see a continuation of that theme. The 10-year note bid up from the European Open. And let me just bring up on my screen a heat map of the futures so I can look around the markets here. So overall, we do see some yields rising in the Treasury complex, particularly on the long end. This is a bit of a recovery that you're seeing from those price lows, yield highs in the 10-year note. Across other commodities, we also have silver selling down. Looks like it put in a larger double top pattern and is heading lower on the intermediate term. Gold is also looking just a little bit stronger than silver, but it does have, I would say, a look that looks a little bit more like a potential head fake again. So I'm cautious with that one. I do think over the longer term, gold can rally to 2,600 later this year and 3,000 next year. But in the intermediate, it's consolidating some of these gains, and it's been a bit of a whipsaw. Let's take a look at Bitcoin. There's been a lot of talk about Bitcoin, which, you know, I get it. It's certainly an instrument that has the attention of the whole world right now. I'm going to see if I can backfill this a little more, and then we'll come back to it. But I would say that the price action that we've seen in Bitcoin recently, the lower highs and the lower lows, tells me that the downside in crypto probably is not over quite yet. I also think that crypto tends to be a relief valve for excess speculative liquidity. And so what that means is when financial conditions tighten, and they've been tightening a lot recently rather quickly, that's not generally very good for crypto pricing. Let's take a look at gold in Bookmap here. I looked at it on the longer term chart. You can see there was a pull overnight, really starting around 8 a.m. You saw a pretty significant pull here, and we're down about 20 bucks, you know, from the point of control to where we're balancing out now. So for now, gold looks like it could be in its own little risk off or, you know, sell down type of mood. And I think that has to do a lot with it keeps flirting with highs and then giving back, flirting with highs and giving back. Some of the things that have driven gold higher are also kind of going more into the background. Like, we're not as concerned as we were yesterday about the whole world falling apart. Apparently, we survived without any emergency rate cuts or other sorts of interventive measures. And by the way, in my view, an emergency rate cut would have been a huge policy mistake by the Fed. But nevertheless, gold is, in my view, it's more of a hedge against uncertainty than a hedge against inflation or anything else. And when uncertainty comes down, so does gold, and it is. Crude oil here, I think crude oil is incredibly oversold, but I don't have the all clear to buy it. We can see there's been a downdraft from the European Open in crude. You could see hedge funds have just completely sold off all their commodity positioning. It's, I think, at the lowest level since 2016. Now, the last time their commodity positioning was this low, we had about a 40-50% rally into the end of 2017, or no, it's to the end of 2018. It was like until October of 2018, you had that 50% rally. I'm not saying that's necessarily the same setup this time around, but what I will say is when positioning becomes that exhaustively low, typically it's closer to a bottom. So that's what I'm looking for. I haven't seen it yet in crude, but I do note that we're pretty close to some key levels of support just below current pricing. So I am watching for that potential reversal, and I'll act on it if I see it. And I'll be watching energy throughout the day today, given how close we are to those levels. Let's look at some of the mega cap stocks before the open. We've got about 15 minutes left here. Apple overnight selling down a bit here from its highs. Again, this is that theme. We had a market that was well bid overnight, but now we're starting to see just a bit of distributed pressure before the US Open from those highs. One thing to keep in mind, some of the overnight trading venues were also closed last night. So folks on Robinhood, for example, were not able to transact. I have to imagine Bats, which is the exchange that does clearing for Robinhood overnight, probably experienced some turbulence on Monday, and that may have caused some issues not only with their systems, but with the liquidity they use to back and clear trades. And so they shut things down last night. And now we're kind of seeing some folks, as the market actually opens for them, potentially liquidating some of these positions into strength. Amazon, kind of a similar look overnight, not quite as dramatic as Apple, but some distributed pressure. Amazon looks decent around this level. I'm not necessarily saying that it's time to go max long, but maybe nibbling a little bit on Amazon as a longer term swing around these levels may not be the worst thing. It's been marked down pretty aggressively. Let's take a look at Alphabet or Google overnight, and we see a similar look being sold off. Got a nice little pop, but we're seeing some more selling pressure in Alphabet. So it sort of comports with that broader view of the European session open leading to some de-risking, and that also overnight US stock open leading to some de-risking. Intel has been a stock I've been watching because it's just had such a significant falling out of bed. It seems to be stabilizing around this $20 level, but I dare say I don't think the problems for the chip maker are behind it, and I'm watching it just as sort of a barometer of pressure in some of the weaker semiconductors. Meta is one that's on a lot of people's minds. This is a company that reported earnings not too long ago, like the rest of the mega caps, had a great reaction to earnings, but folks are walking away kind of questioning that aggressive capex on AI and what it's necessarily buying. There hasn't been a translation to the bottom line in a lot of these mega caps outside of Nvidia, the pick and shovel seller, to actual AI returning profits, right? So Meta has been one of the most aggressive spenders. They bought about 250,000 Hopper chips from Nvidia. They've been training these llama models, and it's supposed to one day maybe turn some kind of profit, but so far not so much. And we do see that same de-risking pattern overnight. And similar with Microsoft, you know, it's that drop, pop, and drop again. And of course, everyone's favorite stock to love, hate, or at least watch, one of the most systematically important stocks in the world, Nvidia. It had the drop, it has the pop, and it's holding on to the pop better than some of its peers. So we'll be watching Nvidia closely today. It did drop to that 95 level, that key technical level on the charts yesterday during that bloody sell-off. And so I think there was a lot of dip buying into that. It'll be very interesting to see how this stock resolves. We also see their Blackwell chips were delayed. That story came out on Friday from an anonymous source at The Verge, or reporting to The Verge and The Information and Bloomberg. Eventually, now it's been confirmed as of yesterday that that delay is real. So that could impact the growth trajectory of this company because it defers some of these chips by 1 or 2 quarters. And then we've got Tesla, the wild card, trading back down to 200. Remember, this thing was at a 250 not long ago. But the company has a lot of issues. They've delayed their robo-taxis pretty much indefinitely, which has been an ongoing theme for some time, but sort of trotted out every once in a while to convince people that that's a potential catalyst for the stock. Then there's some talk about the robots coming on the factory lines and helping to build Teslas. I think we're years away from anything even remotely approaching that happening. But nevertheless, the stock's given back a lot of its gains. And I still think it's very expensive here. So I'm not a huge fan, but I do like to watch it as a meme momentum appetite indicator. You know, folks are bidding stocks like Tesla. They're probably bidding a lot of the other meme momentum stocks as well. So it can give you some other opportunities in different trading vehicles. And one of the big things I would say about Tesla is the big run it's had, and to no small extent, the big run NVIDIA's had, have been largely driven by short-term options trading or prolific gamma squeezes. And often is the case when those run out, it can be pretty painful on the other side, because you've got a lot of dealers that are essentially, when you're buying options from them, when you're buying calls from them, they're hedging their delta, and they do that by buying shares of the underlying, right? So when people stop buying calls, they don't even need to start selling them. Just when they stop buying them, that premium decay compels dealers to start to distribute those hedges, right? Then on the other side of it, if price goes down, the deltas drop, you distribute more hedges. You can see how that becomes a bit of a feedback loop. And of course, people that are in calls are very sensitive to price and time. So they also tend to sell calls when price isn't moving in their favor. So you get that trifecta that can amplify the pressure of those beneficiaries of gamma squeezes on the wrong way, right? When it starts going the other way. So with all that, we're about 8 minutes away from the market open. There's been a lot of talk about a giant carry trade unwind. I'm going to throw my hat in that and just say that as someone who was trading during the great financial crisis, where the carry trade was a dominant theme, where there was a huge positive correlation between the USD JPY pair and the S&P 500, I don't see it right now. The correlation right now is spurious. It swings between positive and negative and none at all. And quite frankly, most of that carry trade, which is about 1.5 to 2 trillion in size, it's far less than the 10 to 20 trillion that some folks have been saying. Most of that carry trade goes more into fixed income than equities. And you can see that in some of the correlation maps that you can build for USD JPY and the price of a 10-year or otherwise. So I would just say be cautious with that prevailing narrative. My thought is what started in Japan was actually more driven by their banks. Some of these Japanese banks are in trouble. They were leveraged up to the eye holes in Japanese equities, US equities, and other Asian equities. When the Bank of Japan blinked last Wednesday, when Ueda did not taper their not QE as much as was the market expected, and he did that token rate hike at the top of the range from 0.10 to 0.25, that was really a blink. And what I mean by that is he did not do what the markets expected. He wasn't as aggressive. And then the guidance was also very vague. So anyone who's reading into that would say he sees something wrong. And then you see what happened on Thursday, right? Wednesday, we had that huge bid pre-market. Really had nothing to do with the Fed or Janet Yellen as much as just the Japanese central bank blinking. Initially, it was seen as positive because this purveyor of excess liquidity to the markets was saying, we're still here, we're still providing, just not quite as much as we were before. Well, then the next days that came, we saw massive de-risking in Japanese banks and exporters. And those Japanese banks were selling down their leveraged positions in Nikkei stocks, in Korean and Taiwanese stocks, and in US futures. So I think more of the story has to do with that component, the Japanese banks. And the other side of it is in the US, hedge funds were piling into USD JPY puts. Why would they bet against their own positions? I don't think they were buying insurance. I think they were riding prevalent momentum, which undermines that theory as well, right? So you can do a correlation chart of the NASDAQ and the Nikkei. You can see they're almost one-to-one correlated for over a year. The bigger story that chart supports is this sort of synchronized rally. And the Japanese banks were a decent part of that. They're some of the larger financial components of the market. So just wanted to put that out there. I'm not so sure that the carry trade is really the driver behind this momentum shift. I think it's a shift in a number of other things. The powder keg was the Japanese banks, but the bigger key theme change is that the AI narrative has been undermined. We're no longer in a period of time where we can say that, there's this hope of imminent profitability and productivity expansion from AI. We can see that with the mega cap earnings, and they're still trying to qualify how all that capex is going to turn into profitability. That means that a lot of what drove the last 2 years of stock market rally is now in greater question because the narrative is changing. So just wanted to put that out there ahead of the market. We're about 5 minutes away from the open. Should be an interesting trading day. We'll be watching how the market opens here what we look for really is that 20-minute opening range, the prevailing options flows, to get an idea as to whether we're going to have a trend day. So I'm going to zoom into a 30-minute time slice on some of these key charts. And again, to go back to some of the themes that I was talking about earlier, this is not a market to be a hero. It is a market to be very, very conservative with position size, because we are in a higher volatility regime with lower liquidity. And you could see it, S&P futures right now, order book only has 40,000. You can also see it if you go to CME. They have a tool called Quick Strike with a liquidity monitor. And you can zoom out to the S&P, NASDAQ, Treasury, any contract you want that's on CME. And you can map out the order book, the bid-ask spread, the cost to trade. All of that shows we are in a less liquid market. So that means we have this sort of leptokurtic distribution of tails. And what that means in plain English is that it takes less volume to move the market. So I'm going to pause for a moment. If anyone has any questions, let us know on the Discord, tag me in there, or in the chat room on the YouTube. And we do have some economic data today. We have the New York Fed Household Credit Report. We also have a 3-year note auction. That household credit report at 11 a.m., 3-year note auction at 1 p.m. So kind of light day for macro, but still some things going on. I think that 3-year auction will be really important, because the gravity of the move on the short end of the curve has suggested that we're going into some sort of imminent economic tailspin. You've got the market begging for an emergency rate cut by the Fed, pricing in the likelihood of a 25 bips cut over the next week at like 60%. I see that as pure insanity. There's almost no chance that's happening. It's a great opportunity to fade that contract. It's a great opportunity to fade SOFR out to December. Quite frankly, that's Fed funds futures, because we're like back to where we were in late 2023. Remember when the market was begging for 7 rate cuts this year? And I was pretty adamant about saying that's complete nonsense. There's no way that's going to happen. We're back to that, right? We're back to that level of sort of begging for the Fed to come back and push liquidity back in the markets. And I think, honestly, if they did that, it would make things worse, not better. And that's why I don't want it to happen. Because if the Fed came in and said, yeah, we're going to do an emergency, 25, 50 bips cut, people are going to wonder, what did you not see last week that you see now? And that would probably amplify concern and angst rather than ameliorate it. So I'm in the camp of, let's wait till, Jackson Hole. Let's see what Powell has to say. I think he'll make it near certain that they cut in September, and we probably see another cut after September, probably in December after the election. But I don't see, really, I see like basically a 0% probability of an emergency cut unless the bottom really falls out. We're only 8% away from all-time highs. And the volatility we saw yesterday, yes, it was jarring. But it wasn't anything extraordinary in the US. It was much more extraordinary overseas in Japan, right? So I can understand them wanting to ring fence that a bit, talk to their banks, figure out what they can do to, maybe try to ensure it doesn't spread around the world again. But in the US, there's no reason for the Fed to come out and try to do a cut. And quite frankly, if they did, it would shrink the rate differential between the US and Japan. And that's not necessarily going to help with any of the impacts of what we're seeing. So for me, I'm not looking for a rate cut. I'm not hoping for a rate cut. If anything, I think the Fed could afford to sit and wait for longer. And the fiscal excess we saw from the government with the Inflation Reduction Act and the Chips and Science Act in summer of 2022, that fought the Fed's tightening cycle. That's one reason they haven't been able to cut earlier. That's one reason inflation didn't come down earlier. That's one reason economic growth continued for as long as it did. So if we want to kind of get grumpy with anyone about the Fed not cutting, we can get grumpy with government fiscal excess. It's the largest deficit spend as a percentage of GDP with unemployment this low ever, to give you a sense. So we're just about a minute away from the market open. Let's focus on that. We have S&P futures on screen. We see a little bit of pressure here. A passive seller just emerged overhead, iceberging 19 contracts in. Small stop out to the sell side, 133 contracts. And we are just seconds away from the open, about 20 seconds away here from the opening bell. And we can see some volatility really starting to pick up with that opening bell. One thing that I really like to watch in the first 5 minutes of trading is whether the order book starts to thicken up, whether we start to see more participants come in. We've gone from 40,000. Well, we were at 41,000 for a brief second. Now we're back there. So we're seeing just a little more liquidity come back. We see a passive buyer coming in. That's what these green diamonds are. Those are passive iceberg buyers coming in. And we can track that on the sub chart too, on this light blue line. Kind of looks like ice. That's the point. Those are showing those icebergs, and we're starting to go more into net positive territory. You could see that in the radio with net positive 259 icebergs so far. Also, you'll note that we track the highs and the lows from the open. So I actually have that kind of set up. You can see the price low here, the price high here. This lets me track the opening range right off the open. I reset these highs and lows so that I can kind of get a sense as to what the opening range is at that 20-minute mark just by glancing at my Bookmap screen. It makes it pretty darn easy to do. And I'm also going to drag my ES aggression indicator in to the sub chart. This is the Bookmap volume pressure indicator, and I've just customized it a bit to really only give me a heads up if there's extreme pressure. And remember, in this first, really 10, 20 minutes of trading, there is some continuation of yesterday's closing trading. There's some orders that weren't necessarily 100% filled. There's some potential for clients to want to continue those orders. So that's another thing to keep in mind. It tends to be pretty erratic and volatile, but it's also a time of basically the first and last hour, and really the first half hour and last half hour are the most liquid times of the trading day. So that's another reason I like to look at order book liquidity in the beginning of the day, because you would hope that during one of the more liquid periods of trading that the 40K would come up, at least by 10% to 45K or so. We do see a decent bid here. We're pushing up above the point of control towards the VWAP. We've got a pretty chunky opening range so far too, about 16 handles, now 17 handles, 18 handles. I do like that. It suggests that, we may have again, this new volatility environment, we may have a more exciting and dynamic trading environment. And folks, if you like what you're seeing on screen, if you think Bookmap would be valuable to you, check out their Discord. Go to discord.com/invite/bookmap. You can join up. There's a lot of educational content on there. If you want to pick up a copy for yourself, visit traderaid.com/bookmap. Scroll down to the specials. You can get up to 40% off. If you'd like to check out TraderAid and what we do there, visit traderaid.com. You can get up to 20% off using the code Mayhem20 at checkout for our Discord plans. So right now we're looking at about just over an 18 handle opening range. I like that. That's a chunkier opening range than we've seen in weeks prior. And it suggests that today could be a bit of an exciting trading day. I personally like a higher volatility regime. I cut my teeth during the great financial crisis doing a lot of trading, so I might be used to more extremes, but I'm not necessarily saying I want anything resembling that level of vol, but I will say I like higher versus lower volatility trading days. It's a little bit more exciting for me. I tend to thrive in those environments a little more. S&P 500 cash up 0.5%, NASDAQ up 0.6%, Dow about flat, small caps down 0.1%, VIX down about 11.5% at the open. S&P futures coming back down here, testing that point of control. Let's take a look around the market, see how some of the other indices and stocks are doing. NASDAQ, pretty similar look to the S&P, although it did briefly break above its VWAP here. And we saw passive sellers come in, and price has been retreating since those passive sellers emerged. Russell not really getting that same implicit bid. Dropped at the open. Little bit of an attempt to pop, now being sold into. 10-year note futures, not really doing a whole lot. This is something really to watch more after the auction, the 2s and 10s, to see how they react. But we're seeing just a bit of a sell, pushing rates higher. Bitcoin also, just a bit of a sell here. We're going to, again, zoom this out to a 30-minute time frame. We've got that on screen. So we're seeing just a bit of a sell. We got that pop and now the drop. I still think Bitcoin over the intermediate term can correct lower, but it can do whatever it wants. We'll have to respect price action and prevailing momentum. For now, however, momentum suggests lower is a higher probability outcome. Gold also chopping a bit here. We're going to take that out to a 30-minute time slice. And yeah, it looks like the path of least resistance for the yellow metal is lower overall. And it makes sense with some of these geopolitical tensions simmering a bit after boiling over the weekend. And also markets calming a bit after yesterday. You know, there was a fair amount of panic if you measure it by what was happening in the bond market or in vol. Not necessarily in trading of equities or the broader indices. I don't necessarily see disorderly trading. Crude, this was one we talked about watching pretty closely. Maybe we're going to start to form a bottom around these levels, right around 72.16 or so. We'll be watching this one. It is starting to try to put in a bottom at those important lower areas of support. It is really quite oversold. Positioning is very negative in it. Hedge funds have dumped a lot of their commodity longs. They're now marginally net negative or net short on commodities. The last time they were net short was 2016, and we had about a 40-50% rally to October of 2018 from there. So, you know, when they get this bearish on commodities, it's usually not a good time to sell them. It doesn't mean it's automatically time to go long. We got to wait for momentum to agree, and that's what I'm talking about with crude. But it does at least have me looking at that as a contrarian, saying, boy, if everyone's gotten out of the trade, that's kind of looking interesting to me. Let's take a look at Apple, and I'm going to also take that time slice out to 30 minutes. And we can see it's selling down. We're going to actually zoom in a little bit so we don't get distracted by that big opening volume. Apple is selling down here. Warren Buffett slashed his stake in the company by half. We found that out during the Berkshire earnings. He's also been selling Bank of America. Fascinating statistic. Berkshire now owns more treasury bills than the Federal Reserve by about twofold. I saw this going around social, and I was like, wow, that's an incredible stat. Let me see if it's true. It's true. We've got a new QE program coming out of Omaha, apparently. Then we've got Amazon. Let's take a look at Amazon. Also seeing that selling pressure off the open here. Got a pretty big resting bid around 160. Again, I dare say Amazon is a swing around these levels. A swing long may not be the worst thing. But I do believe we'll see a corrective impulse. So we may get better prices on Amazon as well. Google seeing some chunky selling off the open here. Looks like down about 1% off the open. Intel kind of violent on that open, like a beach ball getting pushed underwater and then popping back above. This is on my no-touch list. I don't have much interest in Intel. I think that until Pat Gelsinger steps down, this is an untouchable company. He's just really mismanaged it, firing 15,000, cutting the dividend to zero, but not taking any personal responsibility for mismanaging the company and failing on just about every key initiative that Intel needed to launch. Meta, which renamed itself after the metaverse. The reason I bring that up is I think it's funny that everyone was very optimistic about AI and the unlimited CapEx spending there after the metaverse had so much CapEx and nothing to show for it. And now the AI, CapEx spend has become a show me story as well. But Meta also seeing some pressure off the open. Microsoft looks like it's an exception to the rule, getting a bit of a pop off the open here and rebalancing around the point of control and continuing to try to grind higher as it consolidates. Nvidia seeing a bit of a drop off the open here. Similar to a lot of these other NASDAQ stocks. And Tesla, oh, that's a little more dramatic. Tesla seeing a pretty chunky drop off the open here. Looks like it's down almost 2% off the open. Yeah, from its opening levels earlier. So Be keeping an eye on that one as well. It's getting closer to its lows. So let's move back to the S&P 500. S&P looks like it's just sort of balancing around the point of control. You can see we do have this implied bid below. We have this passive iceberg order that is still open just around that most recent higher low that's come in. And we're just about 10 minutes into the trading day, so I'm waiting another 10 minutes to form that 20-minute opening range to get a better idea as to whether my thesis is right, that we have a positive day in the market, and particularly a potential trend day. NASDAQ not looking quite as strong as S&P. You can see why with the stocks we looked at earlier. NASDAQ recently making new lows, but also has a pretty chunky opening range, almost 150 points. And it is starting to grind lower, potentially to new lows here. NASDAQ's looking pretty heavy. Russell's starting to balance it, had that drop at the open, but it looks like it's starting to consolidate those losses and try to make a push higher here. So we'll move back to the S&P 500. We should start getting some options data in from CBOE pretty soon here as well. And we see S&P trading down to where there's this implied bid. That bid was taken right out. So that passive buyer moved out of the way. And we're now making new lows on S&P, which also means we're further expanding that opening range. It's now about a 20 handle opening range. We do see more passive buying coming in lower. Again, those are the green diamonds, and they're showing you the orders as they're coming through, and it also is it's accumulated on this iceberg radial as well as on the subchart. NASDAQ now about flat, up 0.4%. Or 0.0, now 0.03%. S&P up about 1/3%. Dow up about 0.2%. Small caps down 1/4%. Vol up off its lows. VIX is now spot 2689. I'm sorry, 2889. And glancing at the broader futures market, dollar's got a bit of a bid here. Some of the safe haven currencies like the franc and the yen down. Pound sterling, euro down as well. Agricultural complex largely sold down. Most of these grains are down. Really only soy meal and oats are bid. S&P futures here making new lows. See a decent sized stop out happening there. 361 contracts sold to the sell side. Let's zoom out and see what the liquidity situation looks like. You've got a chunky bid here just above 5,200. If we keep grinding lower, that becomes more magnetic. If you think of the market as a bit of a three-way auction, when you have that large of a bid and you're not in a very liquid trading environment, price can get drawn towards it like a magnet, trying to release that liquidity. So we'll be keeping an eye on that as well. We also see a large resting offer overhead, but momentum right now is moving lower. So I'm watching what's below us more adamantly. We're also pushing below that 5th largest level of gamma exposure, which can act as support. And the fact that it's not gives you a sense there is some real selling pressure here. NASDAQ shifting into negative territory, down 0.14%. So we got to respect price action here. We're about 13 minutes into the opening range. It's a lively opening range too. It's about it's almost 25 handles here. That's chunky. So again, that idea of being in a higher volatility environment, that is exactly what we've seen. This is a higher volatility regime. That's something that kind of changes how one should approach the market. To reiterate, because of how important it is, I feel like we need to keep talking about it. This is one of those environments where you really need to size down, because you're going to have to use wider stops not to get, kind of shuffled out of your trades. And that also means, because vol is a bit more amplified, or a lot more amplified, it also means being a little more careful about your execution, right? So we're just going to zoom out a little bit more. See this guy up here with this huge resting offer, or this series of resting offers now. This is interesting. This is Death Cloud at the next level of Death Cloud. And what a Death Cloud is essentially when you have so much liquidity overhead that it's an inordinate amount of supply that can scare buyers away. So this is that look to me. This is an inordinate amount of overhead liquidity. So I'd say up here, it's less magnetic and more a level of potential resistance. And it's quite intriguing because this is also the volatility trigger, right? And what that really means is that that's the largest level of gamma exposure that we see on the entire chain right above. So this could also be based on options. This could be a pretty key level of resistance as well. So both liquidity and options suggest that, maybe we have 125 handles of upside, but before we really start to grind a major resistance. And folks, if anyone has any questions at any time, tag me in, let me know. Happy to address them. You can see that tech is grinding lower here, down about 0.25%. We did get Redbook as well. Johnson Redbook came in just before market open. Year-over-year actual was a positive nominal gain of 5.1%. The prior was 4.5%. So that's decent read of the consumer. They're still spending, although when you look at real retail sales rather than nominal, you can see they've been flat to down since May of 2022, suggesting people are paying more to get the same or less. And we're grinding right back up into Gamma 5 here towards the point of control. We have a pretty chunky opening range, about 28 handles here. So however this opening range resolves, it suggests we're going to have a pretty choppy trading day if we break above and build acceptance or break below and build acceptance. That could make for a pretty nice trend day. But having a big opening range doesn't guarantee a trend day. You still have to break above or below and build some acceptance. Otherwise, you can just have sort of a choppy balance day. So we've got to pay attention to all the things we're seeing and get a sense as to whether there's any edge, there's any favored trade. So far, I have not yet seen one. And again, I do tend to respect that first 20 minutes and the prevailing flow of options before I choose what side I might trade on if I'm putting on a trade at all. We do see a large passive sell. That's 1,000 contracts iceberg sell just above. You can see it on the radial and the sub chart as well. And that was just right there at that point of control. Typically, when you see that large of an iceberg, it can deter buyers a bit. And it does seem to be having that impact now. We also see some of the options data coming on screen for the flows from CBOE. That hot call, wow, someone's very optimistic, at least out of the open. The most active and second most active calls are above price by over 100 handles. The second most active put is below price by about 60 handles, and then that most active put, which is also the most active options contract on the entire CBOE for SPX, is below price by about 140 handles. Now, these positions, these flows can change a bit as we go through the first hour of trading or so, but right now this is a pretty wide distribution of opinions, and that furthers the idea that we're in this elevated volatility regime. We also see the midpoint on screen because right now the variance in volume between the most active two calls and puts is less than 20%. So that means the options auction is somewhat imbalance. In rather than in balance. And this is still not a very robust order book. This is the other thing we talked about monitoring. Well, we're now at the point where we formed the 20-minute opening range. So we're checking back on that, and we're checking back on the order book. Order book's 40K deep. So that means you've got 40,000 contracts on offer and on bid cumulatively in the S&P 500 futures contract. That's not a liquid market. That further suggests that that higher volatility regime on a realized basis intraday is something we have to contend with. The opening range here is pretty big. It's almost 30 handles. It's like 28 handles. So that's the biggest opening range we've seen, obviously, since yesterday. But, going into weeks prior, this is a much bigger opening range than what we've seen. So that also suggests a higher volatility trading environment. And you can see it with the chop. I mean, this is pretty extraordinary for that first half hour of trading versus what we've been used to in weeks prior until very recently. Checking in on market pricing, S&P bid up about 0.5%, NASDAQ up 0.1%, small caps now positive, up 0.25%, Dow 30 Boomer Index up over 0.5%, and the VIX down 11.5% so far. We are starting to build above the point of control here, at least consolidating around it, testing that level. Now, to qualify an opening range breakout, I'd like to see us move above the top of the range, about 3 or 4 handles, and build some acceptance, sort of consolidate there, transact enough that it shows up on the session volume profile, and then I'd qualify that as a breakout, and I'd start to build along, but I would hope that we retest that top, the opening range, and move higher again, and that's where I'd put my full position on. So it does have a look as if we may start to have that outcome. Remember, this is the sort of base case I talked about going into today before we even saw the market open. So that was the plan, but we also need to be sure that we're two-directional, right? That if that doesn't play out, we're still prepared for the other outcome potentially happening. So far, however, we are starting to make new highs from the cash open. So we do appear to be breaking out of this opening range to the upside here. So if we're able to build acceptance up here, consolidate up here 5 or 10 minutes, 3 or 4 handles above the top of the opening range, that tells me we're getting a breakout and I want to get long. And this would be a long only intraday. The markets are very oversold across a number of metrics, whether you look at the NASDAQ or Nicey-McClellan oscillators, the number of stocks above their 20-day moving averages, whether you look at, oscillators like relative strength, whether you look at put skew and the amount of fear out there, the CBOE equity put call ratio, all those things give you a similar impression that there was a lot of fear, and that usually unwinds with a pop. So I'm going to say we are breaking out of that opening range here. We're starting to build some of that acceptance. This breakout may happen a little faster because of this heightened volatility regime. So I'm going to start to nibble a little bit on longs as we start to push higher. But I'm not going to go full position yet because I do need to see some of that acceptance continue to be built up here. And if we kick right back into the opening range and move lower into it, I would close those longs. And that's the kind of setup that I like because the risk to reward is favorable. You can see, nibbling here, I'm not taking a whole lot of risk, and I'm looking for a decent amount of reward that's asymmetrical, right? So I like to have at least 2-to-1 reward to risk. Otherwise, it doesn't make sense. Like I've seen folks that are willing to risk 10 points of loss for 3 points of gain. That does not make any sense to me at all. Flip that on its head. Or there's no point in the trade. It's like, statistically over time, the average win rate the traders have, which is about 60% for the best traders out there, really, you're going to grind yourself into dust if you're taking that much risk on trades. So it's all about that asymmetrical risk to reward. And I am content to call this a breakout of the opening range. I've had about 5 minutes of acceptance built up here. We can see it starting to build into the session volume profile as well. So I would say that we are looking at a uptrend day in the making. The probabilities of that happening are increasing. And again, we have our level. If we needed to stop out of this, it's like breaking back into the opening range. And I would say, down to VWAP, and that would tell us that doesn't look like we're really breaking out anymore. But for now, this is looking like a constructive continuation. It's also nice to see that the market wasn't at its overnight highs at the open. If this market was bid up over 1% at the open, I wouldn't have been nearly excited. But the fact that we almost got flat, like almost all those gains were wiped out, and now we have a chance to kind of rebuild and maybe clean up some of those poor highs from overnight, that also has me a little more constructive. And we could see S&P futures now bid up 0.9%. Tech, the NASDAQ 100 bid up 0.7%. The Dow 30 up 0.8%. Small caps up about 0.5%. And vol, the VIX, is getting smashed lower, which is always good for equities, down 15%. So I'm building into that long position here. Let's take a look at what the options activity is telling us here as well. We see the warm call moving down to a more reasonable level. This typically happens as you see some of these trades get rebalanced. So that warm call now just around 52.90 on ES. And these are SPX options trades that are then being translated into ES levels with the options visualizer tool I built. We can also see the hot call is now the most actively traded contract, right? So maybe we have a chance to try to test this death cloud. It is going to be a level of major resistance given how much is offered up there. But nevertheless, the market is telling us it wants to push higher, and it continues to make new post-cash open highs. So I hope this has been helpful to everyone out there. We got about 2 minutes left in this session. It's been me, Markets and Mayhem from TraderAid with Back to the Futures in partnership with Bookmap. If you've enjoyed watching Bookmap on screen, check out TraderAid.com/Bookmap. That's TraderAid.com/Bookmap. Scroll down to the specials. You can pick up a copy for up to 40% off. If you're not yet on the Bookmap Discord, check it out. They've got a lot of great educational events there, including this stream every Tuesday at 9 a.m. You can join by going to discord.com/invite/bookmap. And be sure to follow me on social if you aren't already. It's the same name on Twitter and YouTube. Mayhem 4 Markets. That's Mayhem number 4 Markets. And I hope everyone out there is having a good trading week. I know it's been rough. Be careful. We are in a new higher volatility regime, smaller position size, wider stops, more discretion, more care in execution, and selecting trades is key. Make sure that the trades you're setting up look like they have better reward than risk. Put the odds in your favor. There's no reason for trading to resemble gambling. This is a business. We need to always have the liquidity to come back the next day and keep trading. The next week, the next month, the next year. Don't put it all on red, right? Trading is really just a business of buying and selling inventory. That's really all it is. You're just trying to capture the spread repeatedly. And to do that, you need to understand why things are trading the way they are, so you have a repeatable system, an approach that you can use that can help you navigate the markets. That's why I've illustrated the approach that I use for intraday trading for you. So hopefully this helps you build that into your system so you can take a more systematic, data-driven approach to how you trade the futures. So this has been me, Markets and Mayhem of TraderAid.com. This has been an episode of Back to the Futures. I'll be back next Tuesday at 9 a.m. I appreciate all of you joining me, and I hope to see you here same time next week.